They said global trade was built to last. But tonight, the world watches as some of the biggest companies on the planet reconsider their place in the most powerful economy on Earth. Apple is shifting. Europe is weighing its options. And China? China is bracing for impact. Welcome to TVAI. The global economic chessboard is being reset, piece by piece, and tariff by tariff. At the heart of this transformation is the United States' bold and aggressive move to dramatically raise tariffs on hundreds of billions of dollars in Chinese imports. What began as a strategy to bring jobs back to American soil has quickly escalated into a worldwide reckoning for multinational corporations. The new tariffs, which range between 25% to as high as 125%, have forced corporations to rethink their supply chains, manufacturing bases, and even their long-standing partnerships. Nowhere is this shift more visible than at Apple Incorporated, the crown jewel of Silicon Valley. With a supply chain that has long depended on Chinese labor, expertise, and infrastructure, Apple is now taking concrete steps to diversify its production away from China. According to insiders familiar with the company's operations, Apple is accelerating plans to move a significant portion of its iPhone manufacturing to India, a move that could redefine tech manufacturing across Asia. This isn't a symbolic gesture. Apple is reportedly investing billions of dollars into Indian manufacturing plants, working closely with local governments, and scaling up its labor force in cities like Chennai and Bengaluru. The motivation is simple: avoid the punishing US tariffs, protect profit margins, and maintain competitive pricing in global markets. But the implications go far deeper. If Apple, a company that epitomizes modern globalization, is making this shift, then the rest of the tech industry may soon follow. This could mean a historic pivot in how and where the world's most valuable products are made. But it's not just Apple, and it's not just tech. European companies, especially in the automotive and industrial manufacturing sectors, are also reassessing their strategies. German automakers like BMW and Mercedes-Benz, which rely on parts and electronics sourced from Asia, are said to be exploring alternate sourcing options within the European Union or even in North Africa. Executives fear that prolonged exposure to US-China tariff volatility could leave them vulnerable to profit losses and sudden operational shocks. French conglomerate Schneider Electric is reportedly evaluating the feasibility of expanding its operations in Eastern Europe, while Dutch semiconductor giant ASML is exploring partnerships outside the usual China-US corridor to shield its business from unpredictable trade policies. These moves are not being taken lightly. Boardrooms across Europe are filled with urgent conversations about agility, contingency planning, and geopolitical risk. What we are witnessing is more than corporate adaptation. It's a realignment of global manufacturing philosophies. Just a decade ago, companies would centralize operations in China for efficiency, cost savings, and reliable infrastructure. Today, risk mitigation is the dominant concern. Countries like Vietnam, India, Mexico, and even Indonesia are now pitching themselves as the next global factories. Governments are offering tax breaks, infrastructure development, and workforce training programs to attract these corporate giants. And in many cases, it's working. India, for instance, has rolled out its Make in India initiative with renewed vigor. The government has been in constant dialogue with CEOs from top-tier companies, positioning the country as a viable, stable, and cost-effective alternative to China. Recent reports indicate that Apple is not the only company making the jump. Dell, HP, and even some smaller chip manufacturers have begun moving trial production lines to Indian soil. Meanwhile, in the US, the Biden administration, ironically, continuing the protectionist policies of the Trump era, is doubling down on reshoring initiatives. With bipartisan support, the government is rolling out grants, subsidies, and tax incentives for American companies willing to build factories domestically. But for global firms, the cost of US-based manufacturing remains daunting, especially when compared to Asia. And so, the solution isn't coming home, it's moving sideways. Another development worth noting is the shift in logistics and shipping. With tariff uncertainties looming, companies are redesigning entire shipping networks. Ports in Malaysia, Singapore, and the Philippines are reporting increased activity as rerouted goods avoid tariff-targeted regions. Global logistics firms like Maersk and DHL are restructuring their service offerings to cater to this emerging multipolar trade reality. Financial markets have taken notice. Stocks of companies seen as de-risking their China exposure are experiencing rallies, while those deeply embedded in the old trade routes are seeing downward pressure. Analysts are beginning to assign new value metrics based on geopolitical flexibility, a term that didn't even exist 5 years ago. The long-term effects of this shift are still unknown, but the short-term disruptions are real. Supply chains are being stretched thin, new suppliers must be vetted and approved, quality controls must be re-established, and local workforces must be trained. This isn't an overnight process. It's a transformation that could take years to fully materialize. But if successful, it will mark the beginning of a new era, a post-China supply chain world. Still, China is not standing idly by. Beijing has issued strong warnings, suggesting that companies who move production out of China may face regulatory hurdles, delays, or even sanctions in the future. The Chinese government has also doubled down on subsidies for local manufacturing, hoping to retain its status as the world's factory. This may result in a dual-track world economy, one aligned with US interests and another orbiting around China. In the end, the winners of this great realignment will be those companies nimble enough to pivot quickly, smart enough to anticipate geopolitical winds, and bold enough to bet on new frontiers. The question remains: is this shift the beginning of a more balanced, diversified global economy, or a prelude to prolonged instability? As the dust settles, one thing is clear: the global business map is being redrawn. Not with ink and diplomacy, but with tariffs, supply chains, and boardroom strategy. More updates coming soon. This is TVAI. Stay informed. Stay ahead.